This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
I want to talk to you about current issues. In the previous syllabus, current issues would come up for a large number of marks. Now they do not. Essentially, if you are aware of about 3 or 4 marks worth of knowledge on the current issues, you will be absolutely fine in this exam. However, it's always good to get those 3 or 4 marks. So the things which I've identified in this chapter are those which the ACCA say are important in the exams up to and including June 2021. The key thing, I think, with current issues is where they are changing existing rules. It's most important that you know the existing rules very well and a little bit about the current issues. So the key thing you can see here on the note in this chapter is make sure you understand how things are at the moment and then try and have a basic understanding of the way in which things might change. So ACCA articles are very useful, as you know, in particular those written by the examining team, which you can see on the ACCA website. So very easy to access, and sometimes the examiner gives us a hint of the sort of way in which he would examine specific issues. There are not many current issues at the moment because over the last few years we've had substantial changes with things like leasing, and so most of them are very wordy. So those of you that like numbers, unfortunately there aren't any calculations involved here. The first one to pick up on is an IFRS practice statement on materiality and making materiality judgments. There are 2 practice statements in the syllabus. One of them is the one which dealt with corporate reporting and the management commentary. This is the other one. Practice statement, in theory, is not mandatory. It's just really trying to tell you a bit in the way in which you should behave. Because international financial reporting standards, in theory, require anything up to 2,000 disclosures, the user of the accounts is left with a muddle of confusion because everything is disclosed. And really, this is just trying to say, let's hold back a little bit and think what is actually material. There are issues then about trying to decide, what material means. Material, of course, is primarily for those people that are providing finance. The government, other users, employees may have other issues, but the primary point is to make disclosure for the investors who've contributed equity and the lenders, again, who've contributed debt finance. So think what might be useful for those particular users. So equity, of course, things like earnings per share. Debtor users, of course, things that would actually help in calculation of things like gearing ratios. Think about materiality by size. Everyone understands that. Just as auditors look at things and get excited about things which are more than 5% of profit before tax. But also think about things which, although they may not appear significant, may be significant by nature. And in particular, one example of that is things like debt covenants. If a company has promised that a certain ratio will not exceed or be less than a certain amount, they risk insolvency if they break that. So that kind of information is critical to the user of the accounts, especially, of course, initially to the lender. Thirdly, make sure the information is clear and concise. And finally, right at the end, stand back and just say, when I look at the whole package of information in the financial statements, at the end of the day, is there anything else that needs to be added in or anything that needs to be deleted? I think the key thing is the word that we've put there that says learn. So if this comes up for four marks and you've got the 4 steps down, that's probably going to get you most of those marks. There's the practice statement on materiality judgments. The second thing is there is an exposure draft. Remember, this is not an accounting standard. It's recent, so it's highly likely to come up for a couple of marks at some stage. It ties in with what we've already said about materiality, because the financial statements are arguably too long and too full of clutter. And if you've looked at an accounting policy note, it's endless. It's 8 or 9 pages, and many of them are stating the absolute obvious that everyone knows about anyway. So essentially, at the moment, IAS 1, that's the standard that sets out things like the accounting formats. So the soft P and the P&L and so on, says disclose significant accounting policies. Some companies have interpreted this of if something moves, even if it's the size of a pistachio, it might be significant, so they tend to over-disclose. So this is only an exposure draft. It's not a standard yet, but what they're saying is actually think about the policies that are material. Same idea, isn't it, as the practice statement. Think about the things that would affect the primary users of the primary providers of finance. So the key things would be if they've changed their policy in the year. So maybe in inventory valuation, they've moved from FIFO to average cost. Of course, they'll have done a prior year adjustment, but that needs to be highlighted. Secondly, if the standard gives a choice, clearly that needs to be disclosed. However, there aren't many of those standards now because most of them, again, don't really give a choice. But of course, an easy one to think about is investment properties, where you can either use the cost model and depreciate, or the revaluation model, where you do an annual revaluation. And finally, it says, make sure we highlight policies where there is no accounting standard. Again, as e-commerce continues to develop, presumably more of those will come to light, but they seem to be quite good at picking up on most things. But they're saying, look, if there is no standard on something, hard to think of anything at the moment, then make sure you've explained how it's been dealt with in the financial statements. There you are. There's that exposure draft. Remember, the current position is IAS 1. Just disclose anything that you think might be significant. The exposure draft, perhaps trying to apply a bit of common sense. The next topic, also in an exposure draft, but this has been knocking around for a bit longer. So it was, this is the second year I think it's been in the syllabus now, is about changes in accounting policies. And it's not about regular changes, it's about unusual ones. There's a body known as IFRIC, the International Financial Reporting Interpretations Committee, and they look at the nitty-gritty of financial statements. And every month or so they have a meeting, they have an agenda. These people, I think, have brains the size of 8 watermelons, and they look at this and they come up with all sorts of technical changes effectively again. Those agenda decisions that they make, again, companies don't have to follow them until they actually change an accounting standard. But a company might decide that the suggestion they've made is a sensible one. Therefore, they might choose to change their accounting policy. And of course, as soon as you change policy, you've got to restate last year. If you're a listed company, you might have to restate the last 5 years or so. And you've got to do a prior period adjustment. You'll remember when you did financial reporting that that's a very messy calculation, even at that level. So essentially, it's another voice of common sense. So therefore, at the end of the day, it's saying, think about cost benefit. You know, the framework now says when you recognize assets and liabilities, think about cost benefit. It's the same theme. So actually, it may be that you decide that the cost outweighs the benefit, and in which case you wouldn't need to do a prior year adjustment. You can see the problem, as always, of course, with these things, because the minute that you give a company the right to think about cost and benefit, judgment, subjectivity, and bias might creep in. The last topic, which I wanted to talk about, is about a discussion paper, which again has been knocking about again for a little while now. And it's really a discussion paper that tries to think about, once again, what is a liability, a financial liability, and therefore, of course, what is the rest, what is equity. Now, a discussion paper comes before an exposure draft. So this is not even at exposure draft stage. So later they'll come back with an ED, and then later they might come back with a standard. So it's very much blue skying, if you like. If you think about things like convertible loans, in the 1980s, we used to treat them as equity. In the 1990s, we used to treat them as debt. And these days, of course, we treat them as part equity, part debt. So it's an ongoing debate. And they're trying to come up with a definition of liability, financial liability, which might work. You know, the current definition of financial liability, remember, is a contractual obligation to deliver cash. And they're perhaps saying, well, maybe that definition is not all encompassing at the moment. Therefore, you can see the proposed definition underneath. If you look at any of the discussions online, if you go on to the Ernst Young or PwC, KPMG, whatever, discussion boards or technical releases, you'll see this is a massively complex area. For your exam, it is not complex. For your exam, it's a couple of marks, and you get your couple of marks if you've learnt the definition. So I wouldn't struggle about spending days and days having conceptual concerns about it. Really, he's just looking that you know it's a debatable issue because it affects things like gearing, and try and get this definition more or less sorted out. Notice it's very broad, this definition. You'll see the word and or in the middle. So it doesn't have to meet two requirements. It might just meet one of them. As it says, the first bit is very similar, isn't it, to what we have now. Unavoidable contractual obligation to transfer cash at a specified time, other than at liquidation. So essentially, again, at some stage during the life of a preference share, it should be redeemed or something. It's moving you towards liability, which of course isn't far from where we are now. But they've also said the definition should also be an unavoidable contractual obligation for an amount independent of the company's available economic resources. Now, what does that mean? Well, it means with an equity share, you pay a dividend depending on how you're doing. If you're doing well, you give them a big dividend. And if you're doing rubbish, you give them nothing. This is saying, isn't it? Look, you've got to transfer the money or whatever it happens to be. I don't care how much you've got in the bank, you've got to transfer it. So in other words, it's for example, a fixed value of cash, or possibly a fixed, again, value of maybe the company's equity shares. So don't stress out about that. Try and see if you can get those two definitions more or less right in your head. The impact, of course, of all of that is it's possible that more things may end up as being liabilities. And in fact, in some cases, perhaps things that are currently liabilities may end up as equity. We'll just have to see. But the main issue, of course, is this affect gearing and leverage. And in the P&L, it affects ratios like interest cover. I've put a couple of examples down. So again, the sorts of things which would be covered by this definition. The first one is a favourite. He's often talked about this, the examiner or examining team. Loans which are convertible into a variable amount of equity shares as opposed to a fixed amount. So the investor is told that at the end of the term, they will receive, again, $10 million worth of shares. So if the shares are worth $1 million, they'll get 10. And if the shares are worth $10, they'll get $1 million. So again, the problem is then all with the company in terms of, providing the finance for those shares. Therefore, again, it implies it's a liability. The other one, again, any share where you are obliged to buy it back at market price. So if the market, essentially again, if the market price is high, the company has got to pay a lot of money out. If the market price is low, they don't have to pay so much. So don't lose sleep about that one. But I have a very strong feeling it will come up once or twice over the next year or so. 3 or 4 marks at the end of a question. So initially, what's the current treatment? Then you pop down the definition. Maybe you could relate it to the characteristics of financial information, like faithful representation, relevance and understandability, and so on. And then have a stab at applying it. Things are not cut and dry with financial instruments. So if you make a little argument and it's not the same as the examiners, will you lose marks? Probably not at all, and certainly not significantly. So give a bit of time to current issues. At the same time, remember, it's not a 25-mark question, but obviously 3 or 4 marks, it's nice to pick those up as you push your way through this wonderful exam.